And you're seeing that. The rumor is the reason they stopped is there's one big trader who took possession and would not roll it over a stamp for cash delivery, perhaps an Asian trader who wanted over 400 million ounces of silver. Give it to me. And so, all of a sudden, the cooling breaks down over Thanksgiving in one of the most thinly traded markets of all. So there's virtually no activity, but just those servers broke down. Right. So the point of it is that this signals, just like the LBMA said, sorry, it's not L plus or T plus 1, it's T plus 8 weeks. Yeah, it is. Only 2 days. Well, today's day 3. I don't have the numbers yet, but 2 days into the December delivery month, and there's already been 23,970 gold contracts that have stood for delivery. That's 2.397 million ounces, and plus 8,305 silver contracts, or 41,525,000 troy ounces issued and stopped so far, and the month has just started. It's also relevant to note that in November, which I would say was not normal, the silver deliveries ended the month at just under 20 million ounces, about 19.7 million, which it's really crazy because November is not a scheduled delivery month for either silver or gold. There was 1,267,000 ounces of gold delivered. Issued and stopped is the correct terminology. But the first day, this month, the December contract, day 1, we saw 7,330 contracts stand for delivery in silver, which is 36, almost 37 million. That's more than $2 billion worth. And although it's not a record, it's close to it. April was the biggest record of just under 12,000 contracts. But to see a 2-day, that's day 1 and 2-day obviously added more, but it's just insanity where there's already been 2.4 million ounces of gold and almost 42 million ounces of silver delivered in 2 days. This is the same type of volume that we've seen all year long. And, it's funny, you and I started talking about this in 2020 before anyone did. And now it's just mainstream mainstream in our business. And I think this will continue until it doesn't, meaning until stuff is just depleted and it's becoming more and more obvious that this is an imminent deal. At the same time, you have one of, if not the largest short position in COMEX futures market, along with a massive short position in SLV, one of the largest ever.
The pressure didn't begin in December. For months, exchange inventories from New York to London have been quietly draining. Since early autumn, nearly 90 million ounces of silver have left COMEX-registered vaults, an exit speed rarely seen in modern market history. Meanwhile, London's LBMA system, traditionally the hub of global metal liquidity, shows signs of exhaustion. As inventories decline, large short positions remain, some of the biggest ever recorded in gold and silver futures. The imbalance is growing obvious. Billions in paper promises contrast sharply with shrinking physical reserves. It's the classic stress point of a system built on confidence and leverage.
And at the same time, you have the LBMA, which is running on fumes. And, it's a situation where the delivery via mechanisms are breaking down. Almost 90 million ounces have been delivered off of COMEX this year, since October, pardon me. And I don't know, since October 1st, 90 million. It's accelerating at a level that I don't think people understand or take for granted. And I think the way that you break that up is just to simply say that, let's make an analogy, right? For years, everyone pretended that, let's call it a cardboard box was full of cookies. There's a picture of a cookie on the outside. And the thing of it, and they would trade that. But now everyone is saying, no, I want the cookies. And people are realizing that the box is pretty much empty. And when that happens, this pretend cookie game, which you could call the derivatives, falls apart. And real cookies, gold and silver, become much more valuable. And that's why prices are rising. And why the dollar and other currencies may look weak when the truth comes out. So, yeah, I think it's a big deal. There was this report that JP Morgan shifted its offices to Asia in the middle of the night, that they were told that the people had like 5 days to move their family and everything to Singapore. I believe that is false. So everything that I'm reading tells me that that's not true. I guess we'll find out and we will see, but I know a lot of people have been asking about that. The bottom line, then again, to me, is that the market runs on trust. And when you believe that you'll get delivery of what you were promised, and that trust has been built up over decades, then the system works. And you buy a contract, you can stand for delivery. The metal's there. That's why COMEX has set the price of gold and silver forever. And the analogy is like a bridge that handles a whole bunch of weight until it doesn't, like the 35W bridge in Minnesota that collapsed that I drove over 5 million times. And you're seeing that in London. You're seeing that in the COMEX now. And I don't know. I think that this is going to be a story that gains a lot of traction over the coming weeks and months. I think that the price of silver is just beginning. I really, truly, truly do. And that nonsense of a outage, a glitch and an outage of air conditioning at the CME, a cooling failure, is a bunch of crap, because only the metals markets went down. You know, the other CME markets, like the bonds and the FX and the repo and the equity futures, well, they stayed online. It was a technical failure isolated to only one asset class, and low volume that day, yet the whole thing went down. To me, it just is telling you that things are breaking. And I don't know. I think that this is just the beginning. We saw 12.5 million ounces were transferred out of the COMEX registered category on November 26th. So, you know, where's it going? Who's buying it? How caught are they? These are the things that I would be focusing on right now. To me, that's the most important thing to talk about today.
The situation resembles a global awakening. For years, paper contracts were traded like the real thing. Layers of derivatives stacked on top of limited physical supply. Now, major players are demanding settlement in metal, not cash or rollovers. It's as if the world finally checked the cookie box everyone traded and discovered it isn't as full as advertised. When too many parties request delivery at once, the old price-setting mechanism begins to wobble. If confidence slips further, exchanges may face the ultimate risk: failure of trust. And in financial systems, trust is not lost gradually. It breaks suddenly and then permanently.
I would just simply say that if a market loses trust in how prices are discovered, or if it can quickly shift the rules, so too will the price discovery. Will shift elsewhere. And to me, all roads lead to the same place, and that's Shanghai, which becomes the price mechanism for physical silver. It will take over for the COMEX. And, you know, when you play these games, we've seen it now in London with the nickel market. We're seeing it here. It's what they did to the Hunt brothers. They changed the rules. They'll raise margin requirements. They'll do all of these things. But when you end up seeing, when you end up seeing a failure of trust, a massive breakdown in trust, I believe that shift will happen. And, it will kind of be like London losing its grip on oil pricing, and move to the NYMEX. And, they ran it for a long time. Now they're an afterthought. The same thing will happen here, I believe, that the world will be so angered, if you will, by the fact that this has been a game that has been played for a long time by the West, that it will move to the part of the world that, the center of gravity will move towards Asia, I guess is what I'm trying to say. So, yeah, I think that's going to happen. I don't know when, but ultimately, in a world of probabilities, I'd put a high level of certainty on that at some point, it just moves to the part of the world that is cash and carry instead of promises and rehypothecation. In other words, you buy in Asia, you pay your money, you get your bars, and out you go. And before you buy it, you have to buy a bar from one of the pre-approved refineries, and they laser etch the number of the contract that you have on that bar. There is no shenanigans there. It's all about shenanigans here in the West.
As stress mounts in Western exchanges, attention is turning toward Asia, especially Shanghai. Unlike the derivative-heavy Western model, Shanghai's physical settlement rules require actual bars, serialized and verified before trading. There are no loopholes, no rehypothecation, no rolling claims, only deliverable metal. If Western markets continue experiencing outages, delays, and inventory strain, global pricing power could migrate eastward. This shift has already happened once before in commodities. London lost dominance in oil pricing as trade volumes moved to the NYMEX. A comparable transition in precious metals would mark a historic rebalancing of global financial power toward physical first markets.
Well, you know what's interesting? The technical analysis would say you take the cup and handle when it breaks through the handle, which it has at over $50, that you take the top of the cup in 1980, which was 50, the bottom of the cup, which was $4 in the 90s, and the difference is 46. You add it to the top, and that would say $96 would be the next technical resistance level, if any, or that would be the projected next place to go. And if you take a 42-to-1 ratio right now, or even call it 45-to-1, where it's averaged for the last 100 years, the silver to gold ratio, even though it's been coming out of the ground for 5,000 years, it's 16-to-1, and now it's 7-to-1, meaning it's depleting in nature. The price ratio, largely because of, in the Western world, gold's role as a monetary metal and silver's role in industry, it's average about 45-to-1. So you take gold today at 42.40 and divide by 45, and what do you get? 42.40 divided by 45 is $95. Well, isn't that interesting? That would be where it would tell you to go, where you take the top minus the bottom, which is 46, add it to the top, that would say $96. So, I mean, if you were to see silver at the end of the year at $96, it would not be crazy at all. And if you take 42.40 and divide by 7, it's going to be somewhere around $600, 605. As insane as that sounds, that would match the geologic footprint right now. So yeah, I think silver is the asset of a generation. And I want to always hammer it home. I'm not telling people to buy it to become wealthy. It is wealth. And the biggest money in the world is showing you that. The sovereign wealth funds and the central banks, who have now largely reclassified silver a critical mineral. The U.S. government has. The EU did it in 2023. China just did it, and they are restricting exports. And China, as we've said ad nauseum on your show, the second largest producer in the world, is flying to Peru and Mexico and buying doré and concentrate, paying twice what the rest of the world will, and ship it back to refine it. If they're the second largest producer, then why the hell are they doing that? Because it's worth far more than the currency used to buy it. The prices are wrong. They've never been allowed to reach full price discovery when you have the largest concentrated commodity, concentrated short position of any commodity of the 1,000 plus traded on COMEX for years. It just speaks to the why. Why would it be the largest short position in this tiny little commodity? It's not for these banks to make money, is it? Sure, they do, but is there something bigger behind it? And we've talked about that forever. So yeah, what we're witnessing right now is the inability of the players that have used the Western dominance, which is big checkbooks, big pockets of cash, to continue to suppress the price naked. It's now an existential threat. And you're seeing that. The rumor is the reason they stopped is there's one big trader who took possession and would not roll it over a stamp for cash delivery, perhaps an Asian trader who wanted over 400 million ounces of silver. Give it to me. And so, all of a sudden the cooling breaks down over Thanksgiving in one of the most thinly traded markets of all. So there's virtually no activity, but just those servers broke down. Right. So the point of it is that this signals, just like the LBMA said, sorry, it's not L plus or T plus 1, it's T plus 8 weeks. Right. We don't have enough manpower or trucks. The Western system is crumbling under their own narrative, and they are losing trust. And that ain't good when a system is completely built on trust and it starts to, as the water recedes, what's the old adage, you see.
Warren Buffett said when the tide goes out, you get to find out who was swimming without swimming trunks. Yeah.
Right. And I think that's going to be a grotesque picture. before it's all said and done. And that's why I think you're seeing a different narrative unfold amongst these banks that maybe the game is over and survival would mean breaking ranks and covering and getting out. You see one of those European banks do that, and then the whole game just implodes as the price skyrockets and shorts get squeezed and they cover, pushing the price up higher. This is a big deal, and I think it's just beginning right now.
Technical models and geological data suggest silver may be entering a transformational moment. A multi-decade technical pattern points to a potential breakout toward the mid-$90 range, levels consistent with historical gold-silver ratios and long-term supply constraints. Meanwhile, silver's industrial role continues expanding across solar, electronics, and battery technologies, even as natural ore grades decline. Central banks and global agencies have reclassified silver as a critical mineral, while China, despite being a top producer, is aggressively purchasing mined material from abroad at premium prices. These actions signal a market where the paper price may not reflect real-world scarcity. Repricing could be violent and fast, and
Well, I mean, I think it's all intertwined because Bo Hines, who was Trump's crypto advisor until August, is now the CEO of USA Tether, which is already Genius compliant and will get the lion's share of all the stablecoin issuance backed by U.S. Treasuries, which, to your point, gives synthetic demand for the Treasury. But the interest on those coins is not transferable. If you buy something and the stablecoin is created backed by treasuries, you spend it, the stablecoin gets burned, it's done. But the interest that was generated on the treasury is not transferable to the holder of the stablecoin. It has to be kept by Tether, who then is buying gold. They have almost $13 billion in gold. They were just at the Beaver Creek Mining Summit. So there's a lot to say about the stablecoin in terms of the ultimate benefit to the gold holder, which devalues the dollar, which we've talked about. That's what they want. The debasement trade. You haven't seen mainstream talk about the debasement trade. Makes paying off your debt easier. And we've talked about how they could develop a roadmap to bring back manufacturing. That is a key part of it. The continuation synthetically of demand for the treasury market, which has lost demand and is continuing to lose demand, but that synthetic demand will then be used to take the revenue from it, drive from it, not give it back to us who hold the stable coins, but buy gold with it. And I wouldn't be surprised if there was a wink, wink, nod, nod between Trump and Tether. You're going to give us that metal. You're going to sign a contract discreetly, maybe even through this exchange stabilization fund, and you're going to sell it to us at some point. Maybe. But anyways, I digress. When you talk about what it could have in store for you, yeah, they have AML, KYC, and KYT compliant technology built into the software. Know your client, KYC, AML, anti-money laundering, KYT, know your transaction. They will know who you are, where your money came from, and what you're buying. And you're right, it is a central bank digital currency masquerading as a stablecoin. The big difference is that instead of it's the CB, there's no central bank. These are independent third-party companies. But isn't it interesting that Trump's crypto czar is now the CEO of this new division that is going to issue the USA Tether tokens? Interesting how that plays out. It's just as interesting as Goldman Sachs saying if the Fed loses independence and the market gets whiff of it, gold will go to the moon. Well, who just took the vacated spot? Stephen Mirren, the head or the gentleman who wrote the Mar-a-Lago Accord, Trump's advisor. These things are not by mistake or by accident, they're by design. And so, to your point, yes, it will have, I believe, all of the characteristics of a central bank digital currency only issued by a third-party entity, that the feds will control the on-ramp and the off-ramp. And so it's the same thing in essence. And I think people should be concerned about it for sure, but it is here and it is going to happen. It is the only way that they will achieve, I think, what they're trying to do through devaluation of the dollar and keeping interest rates low synthetically on both cases. And that devaluation of the dollar will be through the continued increasing purchases of gold and silver with the proceeds behind those stablecoins that are backed by treasuries. The interest on those treasuries not transferable. It's a huge deal. But to the average person, yeah, I think you are just as surveilled as if it were a central bank digital currency for sure. 100%.
Beneath the metals story lies a deeper monetary shift. The U.S. Treasury market faces shrinking global demand, and stablecoins backed by short-term government debt are emerging as synthetic buyers. Yet the interest earned on these treasuries doesn't flow to coin holders. It remains with the issuers, many of whom are quietly accumulating gold. This creates a pipeline where digital dollar adoption indirectly fuels gold purchases, increasing structural pressure on the dollar itself. With former political advisors moving into stablecoin leadership roles and U.S. regulators preparing new frameworks, the system is drifting toward a monitored, semi-centralized digital currency architecture and a rapidly changing monetary future.